Hey, welcome back to another episode of the Financial Beast Podcast. I am your host, your BFFF, best financial friend forever, Eric Miller. And annuities, some people love them, some people hate them. On the latest edition of the Between Two Erics, me and my advisor, Eric Gersch, tackle this subject. What are the pros of annuities? What are the cons of annuities? What are they used for? I think you're going to enjoy it. I think you're going to learn a lot. And as always, please like, share, subscribe to the podcast. Give us some feedback. Let me know how we're doing. And then, as always, if you guys are in need of financial help, do not hesitate to go to our website, econologics.com, schedule an intro call, and hook up with one of our advisors or our specialists so that we can get you on the road to financial independence. Okay, my friends, enjoy the episode. I'll see you on the next one. I had your friend Vinod on the other day.
How'd that go?
It was great. He talked about potential selling, and it was going through the process of deciding whether or not to sell.
Okay.
So yeah, it's pretty fun, but it does lead into another topic that we're going to talk about today, which is the use of annuity contracts for clientele. And I think we bring it up because, when you're dealing with financial advisors, there are a couple different kind. You have people that would consider themselves fee only.
Yep.
Which basically are, I guess, the traditional registered investment advisor. They only charge fees on investable assets that you have and or planning fees. And then you have, of course, the other extreme, which are brokers. And I mean, obviously they're just commission only.
Yep. Commission on the sale of securities.
Yeah. And then you have the hybrid of fee-based, which are people actually like us that are an RIA, but also will charge and have a insurance agency.
We're not brokers sell securities for a commission. We sell insurance for a commission.
Correct.
As insurance agents.
Correct. Yes. We're not selling securities and making a commission on those.
No, never.
But when it comes to insurance-based products, we do.
Yep. Right? Life insurance and annuities are commissionable products.
Correct. So, and obviously in our industry, there seems to be this battle between that, and I don't know why, because it doesn't make any sense to me. Why there would be a conflict there, but it is considered a conflict of interest if you sell insurance-based products and you are also an RIA as well. We have to disclose the hell out of that.
I've actually been trying to understand this better lately because I'm part of a financial group online, and you see a lot of guys that bash anybody who sells any insurance product.
Yeah.
And what I don't understand... Now, before I say this, I should say there are a lot of horrible insurance agents out there that will sell any insurance product to anyone under the sun to get a quick commission.
And we've seen that.
Yeah. Insurance is not nearly as regulated as securities, and there are bad actors in the space. But number one, life insurance is a necessary product, right? Almost every single person is going to need life insurance at some point in their existence.
100%.
And number two, annuities. What I fail to see, and I don't want to go too deep on this, but what I fail to see is what is the difference, honestly, between collecting a percentage-based commission on an annuity or collecting a percentage-based fee on money under management?
Well, I think that is one of the flaws in the argument is that, when I hear most people that rail against insurance-based products, it's they're making a huge commission on this product. And, the way that the pricing and the way that insurance-based products are paid out, it is paid by the insurance company directly to the person. And the pricing is done internally based upon the benefits that they're providing per the contract. But the insurance company pays the agent directly.
Yes.
Now,
it's priced in, of course, but
yeah, of course, it's priced in.
Not technically coming out of a client's account. No.
Correct. But there are 3 different ways that an agent can get paid. Number one, he can get paid all of the commission up front, which is typically like what, 6 or 7%?
Yep.
Okay. And that's it. They don't get any more commissions after that.
Nope, never.
That is done. That's all they get. They get a straight 7% or 6% up front. That's it. Okay. There's a hybrid where you get, maybe 4 or 5%, and then like a lower, what we call trail of maybe like 0.5%.
Yep.
And then there's the model where you usually get like maybe 1 or 2% up front and then a 1% trail, which is almost akin to what you would do, in a fee-based account, a managed account. So literally there's no difference in there. So I think the way that the compensation is paid out doesn't really hold a lot of water as making that an argument of why annuities are bad. No, so to speak. That's been my opinion on that. But just going back to like the entirety of the argument, I didn't know you're in this group. So what other things do they say in terms of?
Well, the argument is on the first example you gave, right, where you can get 6 or 7% up front.
Mm-hmm.
The argument is you're getting 6 to 7 years worth of compensation, assuming a 1% annual fee. You're getting 6 to 7 years of compensation all at once. And that is a massive conflict of interest, which. Okay. Yeah. There probably does that can hold weight in some situations. I'm not going to say it's wrong, but it's still, say I have $100,000 account, right? I get paid $6,000 once. If I put that with a money manager and I pay 1% a year, over the first 6 years, I'm going to pay more than $6,000 in fees. So, yeah, I don't know. I think it all goes back to the advisor behind it, right? Is what is the I don't want to say the justification, but the purpose of the sale.
Well, let's get into that because let's not
bore people with fees forever.
It's good. I think people are going to need to know this. So, they're going to want to know why people would sell these products. And, I think first and foremost, we look at it as a method or a way to create a lifetime income stream for someone. Yep. Okay. That's the first thing why we would use an annuity.
That's the only reason I ever use annuities.
Yeah. It is something. And look, I've run into people that if I would have let them have, or let's just back up and like define what an annuity contract is. Okay. So there's typically 3 parties in an annuity contract. You have the issuer of the annuity, which of course would be the insurance company. Yep. You have the annuitant, which is the person that's actually going to get paid out the money. And then you have the beneficiary, which would be the person, if something happens to the annuitant and there's money left over, that goes to a beneficiary.
Yep.
Okay. The annuity contract basically states a number of things, but I think the basic of it is that the annuity, and depend on the type of annuity. We're going to talk about like fixed index annuities, not variable annuities, because those are securities. The insurance company is going to guarantee your principal, and they're going to give you the option to convert that amount into a lifetime income stream.
A guaranteed lifetime income stream.
A guaranteed lifetime income stream that would last the rest of your life.
Yep.
Okay. And then they generally will have a lot of other benefits, like you can take lifetime income withdrawals or how they classify. Yep. But that's the basic of an annuity right there. That's all it is. Yep. Contract between you and an insurance company. You give them a lump sum of money. They're going to tell you, hey, you can, money is going to be protected from any kind of loss, as long as you don't do anything, stupid, like surrender it early. And you got to get a guaranteed lifetime income. That's it. Like, okay.
And the years in between that deposit and the start of lifetime income, your money is able to grow based on the performance of an outside stock market index, such as the S&P 500.
Yes. And then we'll get into, well, they typically don't perform as well and they don't have the same. And you know what? Oh, that's true to some degree. You know?
Yeah, annuities aren't meant. I mean, if you go back to how they gain return, you get part of the upside and none of the downside.
Yeah.
All right. There's no such thing in the financial world as all of the ups and none of the downs. That would be too good to be true, right? So you get part of the ups. Now, annuities aren't meant to compete with the stock market. They're not. If I have a 20-year time horizon and I put 100,000 into each, I can't say I guarantee, but I can all but guarantee you the stock market account will be worth a good amount more 20 years from now. Most likely.
Probabilities are very high.
Very high.
It's going to be higher in value than that.
But we're not buying annuities for their accumulation benefits.
Nope.
We're buying them for their income benefits.
Yes.
Because that stock market account, I can pull 4 to 5% a year out of. And it'll probably last till I die. Statistically, it will, but
there's no guarantee.
There's no guarantee.
Right.
Whereas the annuity contract is going to pay me out 4 or 5%, maybe even 6%. And it is guaranteed for as long as I live. So really all an annuity is taking money and making it a private pension.
That's right. You are trying to do something to assure that you have a lifetime income so that you don't ever have to worry about running out of money. And you're basically using an insurance company to do what they do, which is insure things.
Yep.
You know, it's not rocket science. That's what they do. And I don't see any reason why carving out a portion of someone's portfolio to put in some kind of a contract like this is not prudent.
No, if you want to look at it on a return perspective, like I said, it's not going to compete with stocks, but
would it compete with bonds?
Pretty similar to bonds.
Yeah, I would say so. Except you don't necessarily have the interest rate risk, although I guess you could say that you do have that. If interest rates go up and down, it affects the index performance and the caps and such.
You don't have default risk is what you don't have.
Correct. You don't.
With bonds, the issuer may default. They may go out of business, and now they can't make interest payments, let alone your principal that they have is gone.
Yeah. So positioning on these things, I think it's better to say that these are more of a fixed income allocation.
100%.
You know, replacement like a fixed income allocation. It's not to replace your stock market allocation. See, this is where agents get in trouble. So because this is where they're going to promise people you're going to get a portion of the gains of the stock market, but you don't have to take any of the losses. I mean, I see it sold like this all the time.
Yeah.
And no one ever says you're going to get a portion of the bond market and you're probably going to match bond gains. Why don't people say that? Because they wouldn't sell if you did that.
I mean, you're going to expect an annuity, a fixed index annuity, the type we're talking about. Realistically, you're probably going to get 3 to 5% return over the long run. Yeah.
Yeah. And the payout could be really good depending on your life expectancy. And if your life expectancy goes a very long time, longer than what you think it is, then you will end up with more money at the end of the day than you likely would have if it was in some other kind of allocation.
Yep.
That doesn't happen all the time, but it does. Okay. So where are you usually positioning annuities then? Like, what are we looking for, you know, both while people are accumulating money and when they actually sell their business?
Yeah. So what I look at is, first we work out two different figures. We call it the RIMI and the DIMI. But basically, how much money do you need in retirement to cover your core costs of living? That's your RIMI. And let's say, for example's sake, that's $8,000 a month. and then your DIMI. How much do you desire to retire on? And let's say that's $15 a month. So that first 8 is what we need to reliably cover. So all we got to do is work backwards. If we have, I don't know, say between me and my spouse, we're going to get $3,000 from Social Security. Now I need 5. Let's say I have $2,000 coming in on a commercial property per month of rental income. Now I need 3. Let's say my spouse has an old pension from a job that they worked 20 years ago. That's just $1,000 a month. Now I need 2. Okay, let's look at how much money we need to put into annuities to generate $2,000 a month worth of guaranteed income in retirement. Now I know that this person is going to have enough in, and we call it mailbox money, pensions, annuities, Social Security, stuff like that. But I know that they're going to have enough to cover their core costs of living. Now, all of the rest of the money, we can be more aggressive with. We can throw it in the market. We can, I don't want to say chase returns, but go for better returns and take more risk, because we always have our safe base to fall back on.
Yeah.
And that's it.
And that's how we position it right there. It's not to replace or to over speculate. It's just to carve out a portion of a person's, and really and truly, you got someone that's, I don't know, maybe 50 years old that's got, $500,000 in IRAs or something like that. I don't know, but to generate $24,000 a year, what do we need? Probably about 200,000 of that 500,000 to carve out into an annuity. I was going to
say somewhere between 2 and 3, depending on how long the deferment period is before they take income.
Yeah. And then at that point in time, it would generally, you could probably generate that. Or somewhere close to that. Okay. And that's the simplicity of it. What about when someone sells their practice? Where do you usually look at it from that perspective?
Same exact perspective.
Okay.
I'm just always looking at how much do they need in reliable income, whether they're working, selling. I mean, that's what I look at.
Yeah, that makes sense. So let's go through some of the general pros then of an annuity contract. I think we touched on some of them already. So number 1, we don't have any stock market risk or any risk of loss.
Correct.
Okay. Number 2, there's a guaranteed income payment that can be generated from there.
Correct.
Right? Now, people have had in the past problems with annuities because they felt like if they died before, then the income stream would stop.
Yeah, and there are certain types of annuities that are like that, but what we use, I've never used something like that. What we use pays a death benefit. Whatever's left in the account goes to the family, so it's not lost. It's not forfeited.
Yeah, so basically, whatever dollar amount that you put in, your family is going to get that back at some point in time, in some way, shape, or form, either through the lifetime payment. But if you die prematurely and there's still money left in the account, that's going to transfer over to the beneficiaries.
Yep.
So
nothing's going to be lost.
Yeah, nothing's going to be lost. Okay, so that would be a pro. Another pro would be that it's likely that we can at least match or exceed in some capacity the fixed income markets.
Yep.
I think that's exactly what another pro would be.
Bond alternative.
A bond alternative. Another pro is just some of the benefits that some of these things have as well. So I would say another pro would be, let's say that you get into a situation where you need long-term care and you don't have any long-term care. What do some of these products have that can help?
A lot of products, not all of them, but a lot of them have what's called a long-term care doubler,
Mm-hmm.
where let's say your lifetime income is $2,000 a month. If you go into long-term care, they'll double it to $4,000 a month for up to X amount of years, usually 3 to 5.
Yeah, for sure.
So it's not long-term care insurance,
Right.
but there's still a good benefit there.
Yeah, you can get the money out faster, and you can get
Yep.
more of it to help offset some of those costs than you normally would have been able to do.
Yep.
What are some other benefits that you see inside the annuity contracts?
I think that pretty well summarizes it. I don't think it's any more.
Well, I mean, look, some of these contracts, the insurance companies offer, benefit. I mean, they can get more creative in the benefits that they offer. They can offer like lifetime withdrawal benefits. They can offer, added returns on, have additional values to them.
Yeah, I mean, there's certain contracts that have these special things, but when we're looking at annuities as a whole, I mean, the benefits are the lifetime income and the principal protection.
Yeah.
And I guess I should say, too, there is one other benefit that I can think of, and that is tax-deferred growth on non-qualified money, so non-retirement money.
Okay.
Usually, gains are taxed as their, well, how do I want to word this? If you have an after-tax investment account, you are taxed on gains. So as you grow, anytime you sell a security and move, from security A to security B, you're taxed on the growth.
Yep.
Inside of an annuity, you are not taxed on the growth ever. No matter what you do, you're taxed on it when you start pulling money out.
Exactly.
So you can change the underlying investments around and not incur tax like you would inside of a investment account.
So what are some of the cons then? I think we kind of touched on some of them. I don't think the fee issue is really a con.
No, that's a behind the scenes industry thing. That's not so much a con to the consumer.
The only con I would think of is that if someone sells something to someone, there really isn't an incentive to then have them meet with that person regularly to go over their annuity contract at that point. That could be a con, based upon how someone gets paid. They're not going to want to go over something every single year with someone where, they're really not getting a compensation on that. That's probably a con.
That's a con. I think the other con, well, there's a few cons. I mean, the second con would be, I guess, opportunity cost, right? And this is something, unless you have a crystal ball, we don't know. But I mean, obviously, if you put your money in an annuity and it grows at 2% over the next 20 years, and you could have put it into this that grew 8%, you're going to be behind. But there's opportunity costs outside of annuities. There's opportunity costs in every dollar you own. So,
exactly.
That
would be like me then blaming the banks for only paying 1% on people when they have a bunch of cash in there. Like, what are you doing?
It goes back to expectations. Were the expectations?
Yeah, for sure.
Realistic when they were set up front.
Yeah, the other con would be, I think, just well, I don't even know if this is a con, but it would be the surrender charge.
They're hard to they're more difficult to exit. Yeah, if you cancel them in the first 5 to 10 years, depending on the product, you're going to pay what's called a surrender charge, which is a charge that they're assessing to you. It's a percentage-based charge assessed to you for canceling your contract. And usually it starts at, say, 10%.
Mm-hmm.
Year 1, year 2 might be 9, year 3, 8, yada, 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 on a sliding scale. So the closer you get to that 5 or 10 year mark where it drops off, the lower the charge gets. But yeah, if you put money in an annuity and then 2 years later, whatever emergency happens and you absolutely need that money, you're going to take a, 8-9% hit to get your own money.
How many times have you seen people have to do that?
Maybe one.
Yeah.
0 to 1.
It hasn't been very many times.
No.
We've seen that. That's where planning comes into play. You got to do proper planning.
Exactly.
But, it is a con. Now, a lot of the times they do have like a free withdrawal amount that you can typically take out every single year.
Correct.
So let's say you put in $200,000 of non-qualified money into an annuity, and then you had an emergency, and you're like, "Oh crap, I need $20,000." Okay.
Yeah, usually the free withdrawal amount is 10% per year.
Yeah, you can take out 10% per year for an emergency.
Yep.
So there is some liquidity to it. It's not great, but there is some liquidity to it that
it's better. It's not completely locked up. It's mostly locked up, but it's not completely.
It's not completely locked up. And, and the charge is still going to be, I think the surrender charge usually starts right around 10 or something like that.
10%. Yep.
10%. So, you'd still get 90% of your money back. It's not like they're going to pay you back, 10% of your money.
Yeah.
But it's not a plus point. Let's just put it that way. I think we hit the return expectations. What would be another con? I guess the fact that the insurance company could potentially have problems. But again, like when have we seen that? Not very often.
I've actually never in my 10-year career seen a client have a insurance or an annuity contract from a company that went belly up. I've never seen it.
Yeah. I mean, you're going to see a lot more banks fail than you are insurance companies.
Yeah. And even if your insurance company does fail, there's safety nets. There's, essentially your annuity contract would be absorbed by another insurance company.
Yep.
And life would go on.
That would likely, back up the benefits and the contract values and all that as well.
Yeah, that's how it works. I mean, say company A is, 10% market share and they go belly up, their contracts are going to be distributed to all their competitors based on the competitors' market share. So if I have a 3% market share, I'm going to get 3% of their annuities.
Yep.
So they're all distributed so that life goes on and the money and benefits aren't lost.
Life goes on. All right. So I think we did a good job on that.
So I think that's the pluses and minuses of annuities.
Yeah. Don't be afraid of them. We use them very strategically. And as long as you're working with someone that, understands where this fits in, you can have a really positive outcome. We got plenty of people that have started turning on their annuity income. They freaking love it.
Yeah, that's what I was just going to say. The last thing that I wanted to say today is you can't put a price tag on or a value tag on what guaranteed income is worth when you're older, when you're retired, when you can no longer work. Having that guarantee that check will keep coming until the day you die is worth a lot. You're not constantly watching CNBC to make sure the markets are up and this and that. Your money's guaranteed. So there's a value to that. I don't know how to value it, but there is a value.
Yep, I agree. Okay, we'll see you guys next time.